Before we begin, a quick and important disclaimer. This video is for educational and entertainment purposes only and does not constitute legal, financial, or tax advice. Divorce laws vary significantly by state, and economic conditions are subject to rapid change. Every individual's financial situation is unique. You should conduct your own due diligence and consult with qualified professionals, such as a family law attorney, a certified financial planner, or a tax expert, before making any decisions regarding your personal or financial affairs. There is a cold, calculated reality that most men in America are never told until it is far too late. In a booming economy, divorce is a tragedy, but in a recession, divorce can be a total financial execution. Right now, as you watch this, the cost of living is squeezing households, interest rates have fundamentally shifted how we value the equity in our homes, and the standard 50-50 split that worked for your father's generation is no longer a viable survival strategy. In previous decades, a man could lose half his assets and rely on a rising tide to float his boat back to the surface within 5 years. Today, that rising tide is gone. According to historical trends and recent case studies, the way you exit a marriage during an economic downturn will dictate your net worth for the next 30 years. If you make the wrong move with your 401k or your mortgage today, you aren't just losing a partner. You are potentially forfeiting your ability to ever retire. This is a high-stakes game of financial chess where the rules have been rewritten by inflation and market volatility. And if you play by the old rulebook, you will lose. This video is the definitive masterclass on navigating a divorce as a man during a U.S. economic recession. We are going to deep dive into the specific, often overlooked strategies that high-net-worth individuals and savvy professionals are using right now to protect their future. We will cover why the procyclical nature of divorce means that while fewer people may be filing right now, those who do are facing more aggressive litigation over shrinking piles of cash. We will solve the problem of how to handle a house that has lost value, but has an untouchable 3% mortgage rate. We will break down why your alimony and child support calculations might be based on phantom income that no longer exists in a cooling job market. By the end of this deep dive, you will have a step-by-step framework to assess your risk, time your filings, and negotiate a settlement that accounts for the harsh economic reality of 2026. To understand the gravity of the situation, we have to look at the data. Historically, divorce rates in the United States have shown a procyclical trend, meaning they often drop during the depths of a recession and spike when the economy recovers. In 2008, during the Great Recession, we saw a noticeable dip in filings. But do not mistake that for happier marriages. It was a poverty trap. Couples stayed together because they literally could not afford the $15,000 to $20,000 in average legal fees, or they couldn't sell their homes because they were underwater. This creates a pressure cooker environment. If you find yourself needing to file now, you are operating in a market where your assets are likely volatile. Consider the liquidation trap. In a standard divorce, the court's easiest path is to order the sale of assets and split the cash. In a recession, this is a disaster. If you are forced to sell stocks while the S&P 500 is down 20%, or sell a property in a buyer's market, you are locking in a permanent loss of capital. A professional script for a man in this position involves in-kind distributions. This means instead of selling the asset and splitting the cash, you divide the actual shares or the property title. This allows both parties to hold the asset until the market recovers, preserving the long-term value. For example, if you have 1,000 shares of a tech stock that has dropped from $200 to $120, selling them now to give your spouse $60,000 in cash is a strategic failure. If you transfer 500 shares to her instead, you both retain the potential for those shares to return to their $200 valuation. Furthermore, we must address the income volatility factor. Many men in the U.S. hold positions with heavy bonus structures or commission-based pay. If your support payments are calculated based on your 2024 or 2025 tax returns, years where the economy may have been stronger, you are setting yourself up for a support deficit. If the recession causes a 30% drop in your total compensation, but your alimony is locked in at your peak earning years, you could find yourself with a debt-to-income ratio that makes it impossible to qualify for a new apartment or a car loan. Step 1 in our masterclass is the preemptive modification strategy. This involves documenting the systemic downturn in your industry and utilizing step-down language in your separation agreement, which allows for automatic adjustments to support if your income drops below a certain threshold due to economic factors outside of your control. Another massive hurdle is the golden handcuff mortgage. Many American men are currently living in homes with mortgage rates between 2.5% and 3.5%. If you divorce and are forced to buy out your spouse, you typically have to refinance the entire mortgage to remove her name and extract her equity. In a recessionary environment with higher interest rates, you could be trading a $2,000 a month payment for a $4,500 a month payment on the exact same house. This is the equity paradox. You might have $300,000 in equity, but you can't afford the cost of debt to access it. We will explore deferred sale agreements and nested occupancy, where you maintain the low-interest loan for a set period, potentially until the kids graduate or rates stabilize, avoiding a total financial wipeout. The cost of divorce itself is also inflating. In 2026, a high-conflict divorce can easily exceed $50,000 per person. In a recession, that is capital that should be used as a peace fund for your new life. We will go deep into collaborative divorce and mediation-first frameworks that are designed to keep your money out of the pockets of litigators and in your own brokerage account. This is not about being nice. It is about capital preservation. Every dollar you spend arguing over a sofa is a dollar that isn't compounding in the market recovery. We are moving away from the emotional side of splitting up and moving into the corporate restructuring of your life. You are the CEO of your future, and your marriage is a subsidiary that is being liquidated. In this recession, you cannot afford to be emotional. You must be clinical. You must look at the tax implications of every move, from the basis of your investments to the head of household filing status. This part of the series is designed to give you the leverage you need to ensure that when the recession ends and the next expansion begins, you are positioned to thrive, not just survive. We are going to look at real-world case studies of men who ignored these trends and lost 70% of their net worth, versus those who used the downturn to rebase their obligations and emerged stronger. This is your survival guide to the most difficult financial transition of your life. To understand why a recession changes everything, we have to look at the concept of the valuation floor. In a stable economy, assets like your home, your 401k, and your business interests have a relatively predictable trajectory. But in 2026, we are seeing a fragmented market where traditional metrics are failing. Imagine a guy named Mark, a project manager in Ohio. Mark and his wife decided to split in early 2025. At that time, their home was appraised at $550,000. Mark, wanting to be a provider and move on quickly, agreed to a settlement where he would keep his full retirement account while his wife took the home equity. Seemed fair on paper. But then the 2026 economic cooling hit. Interest rates stayed stubborn, and the local manufacturing sector took a hit. By the time the papers were ready to be signed 6 months later, that $550,000 house was only moving for $480,000 in a fire sale environment. Mark's retirement account, heavily weighted in tech stocks, had also dipped, but historically, the market recovers faster than residential real estate in specific zip codes. Mark almost signed a deal based on 2025 numbers that would have left him with a massive deficit in actual purchasing power. This is the first rule of recessionary divorce. Never negotiate on stale data. In a volatile economy, a valuation that is more than 30 days old is essentially fiction. We have to talk about the reality of the 2026 job market. For years, the U.S. saw a tight labor market where raises were standard. Now we see a shift toward corporate lean scaling. If you are a high earner, you are likely looking at a compensation package that relies heavily on performance bonuses or stock options. In many states, the court looks at your last 3 years of tax returns to determine alimony and child support. If 2023, 2024, and 2025 were your peak earning years, and 2026 is the year your company cuts bonuses, you are in a high-risk zone. You could be ordered to pay support based on an income of $200,000 while you are actually taking home $130,000. Historical trends suggest that courts are slow to react to macroeconomic shifts. They assume your income drop is temporary or worse, intentional to avoid support. This is why you must maintain a granular paper trail of your industry's health. If your sector is seeing a 15% layoffs rate, that data needs to be part of your legal narrative from day one. You are not just a man going through a divorce. You are a professional navigating an industry-wide contraction. Let's dive deeper into the specific mechanics of the QDRO, or the Qualified Domestic Relations Order. In a recession, the timing of a QDRO can be the difference between retiring at 65 or 75. Most men assume they just split the balance at the time of filing. But if the market is down 20% when you file, and it rallies 15% during the 12 months it takes to finalize the divorce. Who gets that growth? If your settlement agreement isn't precise about the valuation date versus the transfer date, you could be handing over a much larger slice of your future than you intended. Case studies from the 2008 and 2020 downturn show that men who specified a fixed dollar amount rather than a percentage often fared better if the market recovered quickly, whereas those who used percentages were protected if the market continued to slide. In 2026, with the current volatility in the bond market and the fluctuating value of the dollar, you need to work with a financial neutral who understands the specific tax buckets of your retirement accounts. Not all dollars are created equal. A dollar in a Roth IRA is worth significantly more than a dollar in a traditional 401k because of the future tax liability. If you are in a recession and cash is tight, your spouse might be more willing to take a smaller amount of post-tax cash now in exchange for leaving your pre-tax retirement accounts alone. In a downturn, liquidity is king, and you can often use that to your advantage during negotiations. Now, consider the scenario of the small business owner. If you own a plumbing company, a consulting firm, or a franchise, your business valuation is likely the largest bone of contention. In a booming economy, businesses are valued on multiples of EBITDA. In 2026, those multiples are shrinking. If you are the husband and the primary operator of the business, a recession is actually the most strategic time to conduct a business valuation. Why? Because your trailing 12 months of revenue likely reflect the economic slowdown. Lower revenue and lower growth projections lead to a lower professional appraisal. If you have to buy out your spouse's interest in the business, you want that valuation to happen when the outlook is lean, not when it is inflated. We have seen cases where a business valued at $2 million in a peak market was valued at $1.2 million during a contraction. That difference represents $400,000 that stays in your pocket during the buyout. This isn't about manipulation. It's about accurate market reflection. You are paying her the fair market value of the asset at the time of the split, and the market says the asset is worth less today than it was 2 years ago. But what about debt? In the US, we are seeing record levels of household credit card debt and high-interest auto loans in 2026. In a divorce, debt is often split just like assets. However, in a recession, the ability to service that debt changes. If you are the higher earner, you might be tempted to take on more of the marital debt in exchange for keeping more of the assets. Be extremely cautious. If the recession deepens and your income is impacted, that debt becomes a noose. Furthermore, if the debt is in both your names, and the court orders her to pay a portion of it, but she defaults because she loses her job, the creditors are still coming after you. They do not care about your divorce decree. A divorce decree does not override a contract with a bank. This is a common trap that ruins the credit scores of thousands of men every year. The only safe way to handle marital debt in a recession is to pay it off during the asset division phase, or to ensure the debt is refinanced into individual names before the final decree is signed. As we look at the landscape of 2026, we also have to account for the psychological impact of the recession on the legal process itself. When people are scared about money, they become more litigious. They fight over the small things because they feel they have no control over the big things. This leads to what we call the burn rate. Your legal fees are an expense that yields a 0% return. If you spend $30,000 in legal fees to fight over a $20,000 discrepancy in an asset split, you have failed the math. In a recession, you must be the one to bring the cold, hard logic to the table. You must be the one to show the spreadsheets that demonstrate how a prolonged fight will bankrupt both parties. But there is a specific type of asset that most men completely forget to account for in a recession, and it is something that can be traded like a commodity in your settlement negotiations. It involves the way the IRS treats losses and how you can use the current economic pain to create a massive tax shield for your future self. If you don't know how to leverage your capital loss carryforwards, you are leaving thousands of dollars on the table for the government to take. In the next part, we are going to break down the specific tax strategies that turn a recessionary loss into a long-term winning move, and we will reveal the secret of the shadow appraisal, a technique used by the top 1% to ensure they never overpay in a settlement when the markets are crashing. You need to know how to value what you can't see, because that is exactly where your spouse's attorney is going to look next. The secret to surviving a 2026 recessionary divorce lies in mastering the invisible numbers, starting with the strategic use of capital loss carryforwards. Imagine a scenario involving David, a software engineer in Austin who saw his tech portfolio take a massive hit in the market correction of late 2025. David had $80,000 in realized losses from selling off underperforming assets to maintain liquidity. In a standard divorce negotiation, most men look at their brokerage account balance and think that is the only number that matters. They see $100,000 and think they have to give $50,000 away. But David's $80,000 loss is actually a hidden tax asset. Under U.S. tax law, you can use capital losses to offset capital gains, and you can carry forward up to $3,000 a year to offset ordinary income. In a divorce, these loss carryforwards are often considered marital property. If David doesn't explicitly negotiate to keep those carryforwards, he is effectively giving away a tax shield that could save him tens of thousands of dollars over the next decade. Historical trends show that attorneys who aren't financially savvy often overlook these carryforwards, leaving money on the table that doesn't show up on a standard bank statement. You need to look at your joint tax returns from the last 2 years and identify any net operating losses or capital loss carryovers. These are your shadow assets. They have no current cash value but immense future value, especially when the economy recovers and you start generating gains again. This brings us to the concept of the shadow appraisal. In a recession, traditional appraisals are often lagging indicators. They look at what houses or businesses sold for 3 months ago. But in a fast-moving downturn, 3 months ago is an eternity. A shadow appraisal is the process of looking at the forward-facing liabilities that an appraiser might miss. For example, if you own a commercial property that is 90% occupied, a standard appraisal might look great. But if 2 of your major tenants are retail businesses currently filing for Chapter 11 bankruptcy in early 2026, the true value of that building is plummeting. You must provide your appraiser and the court with a dossier of economic headwinds specific to your assets. If you are valuing a business, you don't just show them the profits from last year. You show them the rising cost of goods sold, the increased cost of debt, and the shrinking consumer confidence index in your specific region. By highlighting these negative externalities, you are ensuring the valuation is grounded in the harsh reality of 2026, not the optimism of 2024. Let's talk about the specific danger of the net equity trap. In the United States, we have a long-standing tradition of the husband moving out and the wife staying in the family home with the kids. To make this work, the husband often agrees to take other assets, like the 401k or the brokerage account, to offset his share of the home's equity. This is a potential mathematical nightmare in a recession. Imagine if the house has $200,000 in equity, and the 401k has $200,000. A 50-50 split seems simple. She keeps the house, you keep the 401k. But wait, to get $200,000 out of that 401k when you retire, you will have to pay income tax on every withdrawal. If your tax rate is 25%, that $200,000 is actually only worth $150,000. Meanwhile, she can sell that house and, thanks to the Section 121 exclusion, potentially pay zero capital gains tax on the first $250,000 of profit. In a recession where every dollar of liquidity is precious, you cannot afford to trade tax-free equity for tax-deferred debt. Case studies from previous downturns show that men who ignore the tax-adjusted value of assets end up 20 to 30% poorer than their ex-spouses 5 years post-divorce. You must insist on a tax-affected balance sheet. This means every asset is listed not at its market value, but at its value after accounting for the taxes required to turn it into cash. We also need to address the 2026 reality of the gig economy and side hustles. Many men have spent the last few years building secondary income streams, consulting, e-commerce stores, or rental properties. In a recession, these are often the first things to fail, but they are also the things your spouse's attorney will try to capitalize as a permanent income source. If you made $40,000 in 2025 from a side hustle that is now struggling because of decreased consumer spending, you must fight the imputation of income. This is where the court decides you are capable of earning a certain amount even if you aren't currently making it. They might try to impute that $40,000 to you permanently. To counter this, you need to show the systemic failure of the market. Use data from the Small Business Administration or industry-specific reports to show that your side hustle's decline is a market trend, not a personal choice. Step by step, you need to document the drop in lead flow, the increase in customer churn, and the rising cost of customer acquisition. In a recession, the burden of proof is on you to show why your past success is not a potential outcome for your future earnings. Now, consider the high-stakes world of executive compensation during a downturn. If you are in a leadership role, you might be facing clawbacks or underwater stock options. If you were granted options when your company stock was at $100 and it's now trading at $40, those options are technically worthless. However, a court might still see them as a valuable asset based on their Black-Scholes valuation. This is a complex mathematical formula used to estimate the future value of options. You need an expert witness who can explain to the court why, in a persistent recessionary environment, these options have a high probability of expiring worthless. If you allow these to be counted as a significant part of your asset split, you are essentially trading real, liquid cash for a lottery ticket that has already been scratched and lost. There is also the matter of health insurance and the hidden costs of the 2026 healthcare market. In the US, most men provide the family's health insurance through their employer. When you divorce, you are often required to provide COBRA coverage for your ex-spouse or pay for a private policy for a set period. In an inflationary recession, health insurance premiums are skyrocketing. What costs $600 a month in 2024 might cost $1,200 by late 2026. This is a silent alimony that never ends. You must factor the projected inflation of these premiums into your overall support calculations. If you don't, you might find that while your salary is frozen due to the recession, your mandatory insurance payments are eating up an ever larger percentage of your take-home pay. The goal of this masterclass is to move you from a defensive posture to a strategic one. A recession is a time of extreme stress, but it is also a time of extreme clarity. It forces you to look at the true value of every contract and every asset. You are untangling a business partnership in the middle of a market crash. The men who emerge from this with their wealth intact are the ones who understand that the legal system is a slow-moving machine that relies on outdated data. You have to be the one to provide the new data. You have to be the one to show the court that the world has changed since the day you filed. But even if you get the assets and the taxes right, there is a massive trap waiting for you in the way the US government handles Social Security and future retirement benefits. There is a specific 10-year rule that could either be your greatest leverage or your biggest liability depending on the exact date your divorce is finalized. If you miss this window by even one day, it could cost you hundreds of thousands of dollars in lifetime benefits. In the next part, we are going to break down the Social Security clock and how to time your final decree to maximize your long-term federal protections, and we'll look at the specific 2026 changes to the tax code that could make your alimony payments either a massive burden or a surprising benefit. The clock is ticking, and in a recession, timing isn't just everything. It's the only thing. The 10-year mark is one of the most significant, yet overlooked deadlines in the entire US legal system for a man going through a divorce. In 2026, as Social Security remains a foundational pillar for retirement planning, hitting or missing this milestone can drastically alter your long-term financial security. Under federal law, if your marriage lasts at least 10 consecutive years, your ex-spouse may be eligible to receive Social Security benefits based on your earnings record. This is a critical point. This does not reduce your own benefit. It is an additional pool of money provided by the government. However, the leverage lies in how this affects the overall settlement. Imagine a man named Robert in North Carolina. Robert and his wife have been married for 9 years and 7 months. They are currently in high conflict mediation, and Robert wants the process finished yesterday. He is pushing for a final decree by next month. If Robert signs those papers at the 9-year and 9-month mark, he effectively shuts off his wife's future access to spousal Social Security benefits. On the surface, this might feel like a win, but in a recessionary negotiation, where Robert is trying to protect his liquid cash and his current 401k balance, those Social Security benefits are a powerful, no-cost bargaining chip. By delaying the final decree by just 3 months to cross that 10-year line, Robert can potentially negotiate a smaller alimony payment or keep a larger share of the house equity. Why? Because he is ensuring his ex-wife has a guaranteed, inflation-adjusted stream of income from the federal government in her retirement years. It is the only part of a divorce settlement where you can give something of immense value to your spouse without it costing you a single cent of your own money. If you are close to that 10-year anniversary in 2026, you must look at the calendar before you look at the settlement. Beyond the 10-year rule, we have to navigate the tectonic shifts in the U.S. tax code that have reached a critical point in 2026. For decades, men in high-earning positions relied on the alimony tax deduction to soften the blow of support payments. Under the old rules, if you paid $40,000 a year in alimony, you could subtract that from your taxable income, effectively shifting the tax burden to the recipient. But as we move further into the 2020s, the permanent repeal of this deduction for all new divorces means you are paying alimony with post-tax dollars. If you are in a 32% tax bracket, Paying $3,000 a month in alimony actually feels like $4,400 of gross income leaving your pocket. This is the alimony tax gap, and in a recession it is a silent killer of cash flow. Because your ex-spouse now receives that alimony tax-free, she has a higher net effective income than you might realize. Historical trends show that many men still negotiate support amounts based on what their fathers or older colleagues paid, without realizing the tax math has fundamentally inverted. In 2026, you must negotiate based on net effective income, not gross numbers. Case studies from the last 2 years suggest that savvy negotiators are now using alimony substitutes. Instead of a high monthly cash payment that offers you no tax relief, you might agree to pay for specific, tax-advantaged expenses, or utilize a Section 71 style private agreement if your state allows for specific tax weighting. You have to treat your support obligations like a corporate expense report. If it isn't deductible, it is twice as expensive. Another 2026 reality is the recessionary modification trap. Many men think, I'll just agree to this high support amount now to get the divorce over with, and if the recession gets worse and I lose my job, I'll just go back to court and lower it. This is a dangerous gamble. In the U.S. court system, modifying a support order requires a substantial change in circumstances. Not only is the legal fee to file for a modification high, but courts are notoriously skeptical of men who claim an income drop during a national recession. They often view it as voluntary underemployment, or assume you are just hiding bonuses. Step by step, you need to build a trigger clause into your original 2026 decree. This is a formulaic approach that says if your industry's benchmark index, for example the Nasdaq for tech workers or the Case-Shiller index for real estate pros, drops by a certain percentage, your support obligations automatically adjust without you having to pay $10,000 to a lawyer to reopen the case. You are essentially building an economic circuit breaker into your divorce. We also have to talk about the shadow debt of the 2026 economy. As we sit in this recession, many couples have relied on buy now, pay later, BNPL, services and high-interest fintech loans to bridge the gap. These don't always show up on a traditional credit report during the discovery phase of a divorce. If you aren't digging into the last 12 months of bank statements to find these recurring $100 payments to various apps, you could end up assuming a massive amount of hidden marital debt. Imagine if you agree to take the credit card debt while she takes the car, thinking the car has more value. But then you find out she has $15,000 in outstanding BNPL balances that you are now legally tied to because they were used for household goods. In a recession, debt discovery is more important than asset discovery because there is simply more of it. But the most high-stakes move you can make in 2026 involves the Qualified Domestic Relations Order, or QDRO, specifically regarding the market recovery provision. Most QDROs are written as a snapshot in time. They say half of the account as of June 1st. But in a recession, the market can swing 5% in a week. If the market is at a bottom on your valuation date, but then rallies while the paperwork is sitting on a judge's desk for 4 months, you could be handing over the entire recovery to your ex-spouse. You need a gains and losses clause. This ensures that the person receiving the share of the retirement account also assumes the market risk and the market reward from the day of the agreement until the day of the actual transfer. You are not a bank. You should not be guaranteeing a specific dollar amount in a volatile market. This masterclass is about moving from being a victim of the process to being a participant in a strategic restructuring. You have to realize that the state doesn't care about your financial recovery. Only you do. By timing your filing to hit the 10-year mark, by tax adjusting every dollar of alimony, and by building circuit breakers into your decree, you are protecting your future self from the compounding effects of a recession. But there is one more area that is even more volatile than the stock market or the tax code in 2026. It is the real estate liquidity trap. Most men are currently sitting on a home equity time bomb that is about to go off. In the next part, we are going to look at why the standard advice of selling the house and splitting the cash is the worst thing you can do in this recession, and we will reveal the equity swap strategy that allows you to walk away with your credit and your future intact even if your home is currently losing value. You cannot afford to miss the next section, because your house is either your greatest asset or your fastest path to bankruptcy. The real estate liquidity trap is the primary reason men in the United States lose their financial footing during a 2026 recessionary divorce. For the last several years, the American dream has been anchored by low interest rates, but in 2026, those low rates have become a cage. If you bought or refinanced a home between 2020 and 2022, you likely have a mortgage rate around 3%. Today, as you navigate a divorce, the market rate for a new mortgage is significantly higher, often double or triple that figure. This creates a massive financial friction point. In a traditional divorce, the standard advice is to sell the house, split the equity, and move on. However, in a recession, this move can be a mathematical disaster. Imagine a man named Thomas in a suburb of Phoenix. Thomas and his wife have a home with $300,000 in equity and a 2.75% mortgage. Their monthly payment for principal and interest is $1,800. If they sell that house today in a cooling 2026 market, they might walk away with $130,000 each after closing costs and agent fees. But here is the problem. Thomas now has to find a new place to live. If he wants to buy a modest townhouse that costs half of what his family home was worth, his new mortgage at 2026 interest rates will likely cost him $2,800 a month. He is paying $1,000 more per month for half the house. This is a net loss of lifestyle and cash flow that most men never recover from. Instead of a forced sale, savvy men are looking at the equity swap or the deferred sale agreement. An equity swap involves trading your interest in the home for other assets of equal value. For example, if there is $200,000 of equity, you might allow your spouse to keep the house and her full share of the equity while you keep your entire 401k and the liquid brokerage accounts. In a recession, this is often a win because the house is an illiquid asset with high carrying costs, insurance, property taxes, and maintenance, while your retirement accounts are diversified and have a historical trend of rebounding faster than real estate. You are trading a high-maintenance liability for a low-maintenance growth asset. However, if you cannot reach an agreement on a swap, the next tool is the deferred sale. This is a legal arrangement where you both remain on the deed and the mortgage for a specific period, perhaps 2 or 3 years, until the economy stabilizes or the children finish school. During this time, the house is treated as a joint investment. The separation agreement must be extremely detailed, specifying who pays for the roof repair, who pays the property taxes, and how the eventual sale proceeds will be divided. Case studies from the 2008 financial crisis show that men who held on to their real estate interests until the market bottomed and began to recover often realized 40 to 50% more in actual cash than those who engaged in a fire sale during the panic. You must also understand the danger of the buyout appraisal. If you are the one staying in the house and buying out your spouse, you want the appraisal to happen during a market dip. But if you are the one leaving and being bought out, you want the appraisal to reflect the long-term value. In 2026, we see a wide gap between what an appraiser says a house is worth and what a buyer is actually willing to pay. This is the liquidation discount. If you are being bought out, ensure your attorney argues against a liquidation discount. Just because the house might take 6 months to sell in a recession doesn't mean its intrinsic value is lower. Let's look at a high-stakes scenario involving a guy named James in Denver. James owns a small portfolio of 3 rental properties in addition to his primary residence. In a 2026 recession, his rental income has tightened because his tenants are struggling. His wife's attorney is trying to value these properties based on the peak prices of 2024. James, however, uses a debt-to-equity analysis. He shows that while the properties have high paper value, the cost of servicing the debt and the increased vacancy risk makes them low-yield assets in the current climate. By focusing on the cash-on-cash return rather than the speculative market value, James is able to negotiate a settlement that reflects the actual economic utility of the assets. He avoids a situation where he is ordered to pay his wife 50% of a paper value that he cannot actually access without selling the properties at a loss. Another critical factor in 2026 is the property tax reassessment. Many states have seen massive jumps in property taxes over the last few years. If you are the one keeping the house, you must factor the future tax burden into your budget. In a recession, while your income may be stagnant or falling, property taxes rarely go down. This is part of the carrying cost of divorce. You must ask yourself, can I afford this house on a single income with 2026 tax rates and 2026 utility costs? If the answer is no, then the house is not an asset, it is a trap. You are better off letting your spouse keep the house and the debt that comes with it, while you take the liquid cash and wait for a better entry point into the real estate market. Furthermore, we must address the 2026 trend of cohabitation out of necessity. Because of the recession, more men are finding themselves in a situation where they are legally separated but still living in the same house as their ex-spouse because neither can afford to move out. This is a legal minefield. In many U.S. jurisdictions, the clock for your date of separation doesn't start until you are living in separate residences. If you live together for a year to save money, you might accidentally extend the length of the marriage, which could increase your alimony duration or change the valuation date of your assets. You need a formal living apart together agreement that clearly defines your separate lives within the same four walls. This includes separate bank accounts, separate grocery bills, and a clear move-out timeline. The real estate market in a recession is a game of patience and precision. You are not just dealing with bricks and mortar. You are dealing with your largest source of debt and your most significant tax shield. If you handle the house correctly, you can use it as leverage to protect your more important assets, like your business or your retirement. But if you handle it poorly, you will be house poor for a decade, watching your ex-spouse thrive while you struggle to keep the lights on in a home you can no longer afford. But real estate is only one half of the survival equation. While you are busy protecting your home and your bank account, there is an even more aggressive force working against you in the background: your career. In a recession, a man's job is his most vulnerable asset. In the next part, we are going to dive into the career defense protocol. We will show you why your professional reputation is currently under more scrutiny than ever before, and we will reveal the specific tactics used in 2026 to prevent your divorce from destroying your standing at your company. We will also discuss the promotion trap, why getting a raise during your divorce proceedings might be the most expensive mistake you ever make. You need to know how to manage your boss and your HR department before your spouse's attorney gets to them first. The career defense protocol is your frontline strategy for preserving your primary income engine, while the world around you feels like it is shrinking. In the United States of 2026, the intersection of a professional career and a personal crisis is a high-risk zone. When a recession hits, companies move into a state of hypervigilance. They are looking for reasons to trim the fat, and any sign of personal instability can be interpreted as a lack of focus or a liability. You must understand that your employer is not your friend. Your employer is a counterparty that needs to see you as a reliable, high-output asset, regardless of what is happening at home. Imagine a professional named Christopher, a director of operations for a logistics firm in Chicago. Christopher is in the middle of a contested divorce. His wife's attorney has already served a subpoena to his HR department requesting his last 5 years of performance reviews, bonus structures, and expense reports. To a corporate entity, this looks like drama. To Christopher, it looks like a routine legal request. But in a recessionary climate where the firm is looking to cut 10% of its workforce, Christopher has just painted a target on his back. The first step in the career defense protocol is controlling the narrative. You should not wait for the subpoena to arrive. Instead, you proactively have a brief, professional conversation with your direct supervisor or your HR business partner. You do not overshare. You do not complain about your spouse. You simply state that you are going through a personal restructuring that may involve administrative requests for documentation, but that your commitment to your KPIs and the company's 2026 growth targets remains absolute. By being the one to deliver the news, you strip the situation of its gossip value and frame it as a managed administrative task. We must then address the promotion trap. In a normal economy, a promotion is cause for celebration. In a 2026 divorce during a recession, it can be a financial landmine. Historical trends show that alimony and child support are often calculated based on your income at the time the final decree is signed. If you are in the middle of negotiations and you accept a promotion that comes with a $20,000 raise, your support obligations will likely be calculated based on that new higher number. However, in a recession, the last person hired or promoted is often the first one out during a restructuring. If you take that promotion, lock in higher support payments, and then get laid off 3 months later, you are stuck with a support obligation that you can no longer afford. Case studies from the 2008 downturn highlight men who deferred promotions or negotiated for non-monetary benefits, like extra vacation time, remote work flexibility, or better health insurance, until after their divorce was finalized. This is not about avoiding work. It is about strategic timing. You want your permanent support obligations to be based on a sustainable, realistic income level, not a temporary peak that carries high risk. Furthermore, you need to protect your professional intellectual property and your goodwill. In many U.S. states, if you are a high-level executive or a specialized professional, the court may attempt to put a dollar value on your professional goodwill or your enhanced earning capacity. They argue that the marriage contributed to your career success, and therefore, she is entitled to a portion of your future earnings. In 2026, you combat this by documenting the recession's impact on your industry. You provide evidence that your earning capacity is not an evergreen asset, but is highly dependent on market conditions that are currently unfavorable. You show that your industry is shifting, that AI is automating roles, or that consumer demand is falling. By devaluing the speculative future of your career, you reduce the amount of cash you have to pay out today to buy out her alleged interest in your future work. Let's look at the expense account audit. In a recession, companies are auditing every nickel. If you have been using your company credit card for things that could even remotely be construed as personal, even if it was common practice in your office, a divorce will bring those to light. Your spouse's attorney will look for wasteful dissipation of marital assets. If you took a client out to a dinner that cost $500 and your spouse claims it was actually a personal date, you are now fighting a war on two fronts. One with your wife and one with your company's compliance department. In 2026, the rule is absolute. Clean up your professional ledger. Stop all overlapping expenses immediately. You need your employer to see you as the most disciplined, fiscally responsible person on the payroll. Now, consider the remote work leverage. Many men in 2026 have negotiated remote or hybrid schedules. In a divorce, your location can be a massive financial lever. If you are no longer tied to an expensive city like San Francisco or New York because of your job, you can use that mobility in your negotiations. If your spouse wants to stay in the high cost of living area, you can argue that she should bear the burden of that cost while you move to a more recession-proof, low-tax state. However, be careful. Moving can impact your custody standing. You must balance the geographic arbitrage of your career with the best interests of the child, standard that U.S. courts use. We also have to discuss the bonus deferral strategy. If your company pays out an annual bonus in March, and you are filing for divorce in January, that bonus is likely a marital asset. If you can legally and ethically work with your employer to defer that bonus or move it into a non-monetary form like restricted stock units, RSUs, that don't vest for 3 years, you may change how that asset is treated in the settlement. In a recession, a bird in the hand is worth 2 in the bush, but in a divorce, a bird that doesn't vest until 2029 might not be considered a divisible asset today. This requires careful coordination with a tax professional to ensure you aren't violating any IRS rules regarding constructive receipt of income. The Career Defense Protocol is about realizing that your job is the foundation of your recovery. If you lose your cool at the office, or if you let the divorce distract you to the point where your performance slips, you are losing the only tool you have to rebuild. You must be the most boring, most productive version of yourself. You are a professional who happens to be navigating a legal process, not a victim who happens to have a job. But even with your career protected and your house secured, there is a psychological warfare element that happens in a recessionary divorce that can bankrupt you faster than any market crash. It is the attrition strategy. This is when the other side intentionally drags out the process to exhaust your liquid cash, knowing that in a recession, your burn rate is higher than your earn rate. In the next part, we are going to break down how to spot the attrition strategy and the specific legal aikido moves you can use to force a settlement when the other side is trying to bleed you dry. We will also discuss the role of litigation financing and why you should never, ever use your credit cards to pay your lawyer in 2026. You need to know how to win the war of nerves before you run out of ammunition. The attrition strategy is a psychological and financial siege designed to make you surrender your long-term assets in exchange for immediate relief from the pressure of the legal process. In the United States in 2026, where liquid cash is harder to come by and interest rates on debt are punishing, this strategy is particularly effective. The goal of the opposing side is simple. They want to increase your burn rate until it exceeds your tolerance for pain. If they can keep you in discovery, delay mediation, and file unnecessary motions for 6 months, they know that a man with a $10,000 monthly mortgage and high support obligations will eventually run out of cash. At that point, you become desperate. You start offering to give up 100% of your retirement or your business equity just to make the monthly legal bills stop. Imagine a man named Michael, a mid-level executive in Seattle. Michael is facing an attrition strategy. His spouse's attorney is requesting every single receipt, text message, and bank statement from the last 7 years. Each time Michael's lawyer responds, it costs $3,000 in billable hours. Michael is watching his savings vanish while he is still paying for 2 households in a recession. The countermove here is legal aikido. Instead of resisting the momentum, you use it to force a resolution. This involves the strategic narrowing of issues. You don't fight every battle. You identify the 3 things that actually move the needle: the house, the pension, and the custody schedule, and you stipulate to everything else. By removing the noise, you make it harder for the other side to justify the delays. You also utilize the formal offer of judgment. In many U.S. jurisdictions, if you make a formal, reasonable settlement offer and the other side rejects it only to get a worse result at trial, they may be responsible for your legal fees from that point forward. In a recession, the threat of having to pay your legal fees is a massive deterrent to the attrition strategy. We must also talk about the specific danger of using credit cards to fund a 2026 divorce. With average credit card APRs hovering at record highs, using plastic to pay a $50,000 legal bill is a recipe for permanent debt. Historical trends show that men who carry legal debt into their post-divorce life struggle to rebuild their net worth for over a decade. If you are cash poor but asset rich, you should investigate litigation financing. This is a specialized form of credit where a lender provides the capital for your legal fees in exchange for a portion of the final settlement. While it can be expensive, it is often structured as non-recourse debt, meaning if you don't win the asset, you don't owe the money. More importantly, it levels the playing field. If the other side knows you have the funding to go the distance, their attrition strategy loses its teeth. You are no longer the man who is about to run out of money. You are a man with a fully funded legal defense. Let's dive into the 2026 reality of business interruption claims in a divorce. If you own a company and the divorce process is so intrusive that it is actively damaging your business's ability to operate during the recession, you may have grounds for a protective order. This prevents your spouse's attorney from contacting your clients, your suppliers, or your employees. In a recession, a single rumor that the owner of a company is in financial trouble can cause a run on the bank or a loss of key contracts. You must protect the golden goose. Case studies from recent years show that men who failed to get protective orders early in the process saw their business valuations drop by 30% purely due to the reputational damage of the litigation. You need to frame the business not just as a marital asset, but as the primary source of support for both parties. If the business fails, the alimony stops. This is a logic that even the most aggressive opposing attorneys usually understand. Now, consider the psychological burnout factor. In 2026, the mental load of managing a career in a cooling economy while fighting a legal war is immense. This is where men make mistakes. They send an angry email at 2 a.m. They post something on social media. They mention their frustrations to a colleague. In a high-stakes divorce, your emotions are a liability that can be monetized by the other side. If you appear unstable, they will use that to push for supervised visitation or to argue that you are incapable of managing your finances. The step-by-step detail here is the communication firewall. You stop all direct communication with your spouse regarding the divorce. Everything goes through a parenting app or through counsel. This isn't about being cold. It's about being clinical. You need to preserve your emotional bandwidth for your job and your kids. Furthermore, we need to address the shadow discovery of the 2026 digital age. Attorneys are now using AI-driven forensic tools to scan years of Venmo transactions, Uber logs, and even Netflix watch histories to build a profile of your lifestyle. If you claim you are struggling financially because of the recession, but your Venmo shows you are still paying for high-end golf outings or premium subscriptions, you are undermining your credibility. In a recessionary divorce, your lifestyle must match your financial declarations. You cannot claim poverty in a deposition while your digital footprint suggests luxury. You need to conduct a digital audit of your own accounts before the other side does. This is about ensuring consistency. If the economy is down, your personal spending should reflect that downward trend. This isn't just about saving money. It's about providing a coherent narrative to the court. There is also the matter of the vocational evaluation. In a recession, your spouse may claim she is unable to find work and therefore requires higher alimony. In 2026, the job market is tight, but it is not non-existent. You must insist on a vocational evaluation by a third-party expert. This expert will analyze her skills, her education, and the current local labor market to determine her true earning capacity. Even in a downturn, there are sectors that are hiring. By proving she has the ability to earn an income, you can significantly reduce the duration and amount of your support obligations. Historical trends suggest that courts are much more likely to order a step-down alimony plan if you can provide a concrete roadmap for the other party's return to the workforce. The attrition strategy only works if you are reactive. If you are the one setting the pace, if you are the one providing the expert data, and if you are the one utilizing smart financing, you turn the tables. You move from a state of being hunted to a state of being a negotiator. You are looking for the exit ramp that preserves the most capital, In this recession, every month the case stays open is a month of lost interest and lost growth. You have to be the one to drive the case toward a conclusion. But as you near the end of the legal process, a new and even more complex challenge emerges. It's the moment the judge signs the paper, and you realize that the world you are stepping into is financially different than the one you left. There is a specific post-divorce rebound strategy that involves the 2026 tax laws and the way you retitle your remaining assets to ensure you are the first to benefit when the recession finally breaks. In the next part, we are going to look at the Fresh Start accounting method. We will show you how to audit your own decree for hidden traps that could trigger IRS audits years down the line, and we will reveal the secret of the asset rebasing move that can potentially save you six figures in future capital gains. You've survived the war. Now you need to make sure you win the peace. Winning the peace starts with Fresh Start accounting, a process that must be executed the moment the ink is dry on your final decree. In the United States of 2026, the transition from a married taxpayer to a single taxpayer during an economic contraction is fraught with administrative landmines. If you simply walk away and assume the paperwork is done, you are inviting the IRS into your life for a post-divorce audit that could strip away the very assets you fought to keep. Fresh Start accounting is about scrubbing your financial identity clean and rebasing your assets to reflect your new reality. Imagine a man named Steven, a middle manager in Atlanta. Steven just finished a grueling 18-month divorce process. He kept his 401k and a rental property, while his ex-wife kept the primary residence. Steven's first mistake was failing to update his cost basis records. In 2026, the IRS has increased its focus on digital asset tracking and automated audits. If Steven sells that rental property in 3 years when the recession ends and the market rallies, the IRS is going to look for the original purchase price to calculate his capital gains tax. If Steven doesn't have the specific records from the marriage, or if he hasn't officially rebased the asset through a process called step-up of basis, which can sometimes be triggered during asset transfers depending on the specific language in the decree, he might end up paying taxes on gains that occurred while he was still married. The step-by-step detail here involves the asset rebasing move. This is where you and your tax professional sit down and create a new ledger for every asset you retained. For stocks, you need the original purchase date and price. For real estate, you need a record of every capital improvement made during the marriage. If you spent $40,000 on a new roof and windows in 2024, that $40,000 should be added to your cost basis, which lowers your future taxable profit. In a recession, these records are often lost in the chaos of moving or emotional exhaustion. But in 2026, data is currency. By securing these records now, you are essentially prepaying your future tax bill with information rather than cash. Next, we must address the 2026 Qualified Domestic Relations Order, QDRO implementation gap. Many men think that once the judge signs the divorce decree, the retirement accounts are automatically split. They are not. A QDRO is a separate legal document that must be approved by the plan administrator of your 401k or pension. In a recession, plan administrators are often backlogged or operating with reduced staff. If you wait 6 months to file your QDRO, and the stock market rallies 15% during that window, the specific language in your decree will determine who gets that growth. If the decree says she gets $100,000, but the account grows while you wait, you might be accidentally giving her a windfall. Conversely, if the market dips further, you could be losing value you thought was protected. You must ensure the QDRO is drafted, served, and executed simultaneously with the final decree. Case studies from the early 2020s show that the average delay in QDRO execution was 4 to 7 months, leading to thousands of dollars in accidental transfers due to market volatility. We also have to look at the beneficiary audit. This is a critical safety check for 2026. In most U.S. states, a divorce decree automatically revokes your ex-spouse status as a beneficiary on life insurance or retirement accounts. However, this is not a universal rule, especially for plans governed by federal ERISA law. If you forget to manually change your beneficiary from your ex-wife to your children, a trust, or your estate, and something happens to you, the federal government may uphold the original beneficiary designation, regardless of what your state divorce decree says. This has led to high-stakes litigation where ex-spouses receive million-dollar payouts, while the man's children are left with nothing. In 2026, with the increased complexity of fintech accounts and various insurance products, you must perform a top-to-bottom sweep of every account that has a named beneficiary. Furthermore, let's talk about the credit repair phase. During a recessionary divorce, your credit score usually takes a hit. Perhaps a joint credit card payment was missed during the heat of litigation, or the high balance-to-limit ratio from legal fees has dragged your score down. In 2026, your credit score is your passport to economic recovery. You will need it to refinance that house, get a lower rate on a car, or even pass a background check for a new job. Historical trends show that men who proactively use credit rebuilding tools, such as secured cards or credit builder loans, can see a 100-point swing in their score within 12 months of a divorce finalization. You need to pull your tri-merge credit report immediately after the divorce to ensure that all joint accounts are marked as closed and that you are not being held liable for any new debt your ex-spouse might be accruing. Now, consider the liability firewall. Even if you are divorced, you may still be linked to your ex-spouse through joint tax returns filed in previous years. If the IRS audits your 2024 or 2025 joint return and finds an error on her side of the ledger, they can come after you for the full amount. This is known as joint and several liability. In 2026, you should negotiate for an indemnification clause in your decree. This means if the IRS comes knocking for her past mistakes, she is legally required to pay the bill and cover your legal costs. Without this clause, a recessionary divorce can have a long tail of debt that snaps back at you years later. Let's look at an imagine-if scenario involving a guy named Kevin in Denver. Kevin finished his divorce and immediately moved into a high-end apartment to start fresh. He didn't account for the fact that his alimony was now post-tax and his child support was fixed. Within 6 months, he was underwater despite having a high salary. This is the lifestyle creep trap. In a recession, the cost of maintaining a single life can be surprisingly high. You are no longer splitting the cost of internet, utilities, or bulk groceries. Kevin should have used the 70-30 rule. Live on 70% of your post-support income and save 30% as a recession buffer. In 2026, cash flow is more important than your ego. The man who lives in a modest apartment and drives a used car for 2 years post-divorce is the man who will have the capital to buy assets at a discount when the economy finally pivots. The goal of Fresh Start Accounting is to ensure that the total cost of divorce is capped at the moment of the decree. You are stopping the bleeding. You are retitling your world so that every hour you work and every dollar you save from this point forward belongs 100% to you and your future. You are no longer working for a ghost. But even with your finances in order, there is a final massive hurdle that most men in the US fail to clear. It's the intergenerational wealth trap. In a recession, your parents or your extended family might be looking to leave you an inheritance or help you out with a gift. If you don't structure these future windfalls correctly, they could be classified as income for the purposes of increasing your alimony or child support years after your divorce is over. In the next part, we are going to dive into the future-proofing of your estate. We will show you how to protect future inheritances and why your 2026 estate plan needs to be written with anti-modification clauses. You've secured your present. Now you need to make sure your family's legacy isn't on the table in the next round of negotiations. The intergenerational wealth trap is a sophisticated financial vulnerability that many American men overlook until their parents or elders begin the process of estate planning during the man's own post-divorce recovery. In the economic climate of 2026, where many older Americans are holding on to significant real estate and market assets despite the recession, the way you receive an inheritance can dictate whether that money stays in your bloodline or becomes a secondary target for future alimony or child support modifications. While inheritances are generally classified as separate property in the United States, the income generated from those inheritances is often a different story. If you inherit a $3 million portfolio and it generates $150,000 in annual dividends, a court could potentially view that $150,000 as a change in your financial circumstances, leading to a motion to increase your monthly support obligations. Imagine a man named Gregory, a high-level consultant in Virginia. Gregory finalized his divorce in early 2025. In late 2026, his father passes away, leaving him a significant family estate including several debt-free properties and a substantial brokerage account. Gregory thinks he is safe because the divorce is over. However, his ex-wife's attorney monitors public records and social media. Seeing Gregory's change in lifestyle, they file for an upward modification of child support. In many jurisdictions, even if the principle of the inheritance is off-limits, the new income stream it provides can be used to justify a higher standard of living for the children, effectively transferring a portion of Gregory's family legacy to his ex-spouse's household. To prevent this, Gregory should have utilized a spendthrift trust or a bloodline trust. These are specific legal vehicles where the assets are held by a third party for your benefit, but you do not technically own them. Because you do not have direct control over the distribution, the assets and the income they produce are often shielded from being factored into support calculations. This is a crucial step-by-step detail. Before the inheritance is ever distributed, you must work with your parents to restructure their wills or trusts into a discretionary format that protects the beneficiary from creditors and ex-spouses. We also have to discuss the 2026 anti-modification clauses. When you are signing your original separation agreement, you want to include language that limits the ability of either party to seek changes based on future windfalls. Historical trends show that men who negotiate for a non-modifiable alimony provision, even if it means paying a slightly higher amount upfront, are protected from the success tax. If you start a new business in 2027 that becomes highly successful, or if you receive a massive promotion as the recession ends, an anti-modification clause prevents your ex-spouse from coming back to the table for a second bite of the apple. In a recessionary environment, you have more leverage to negotiate these clauses because the other side is often more concerned with the immediate certainty of cash flow than with hypothetical future gains. You are essentially buying your future freedom with today's liquidity. Let's look at the gift tax gaps of 2026. In the U.S., the annual gift tax exclusion allows individuals to give up to a certain amount per year to another person without triggering a tax return. In a recession, your parents might want to help you with your legal fees or your new mortgage. If they write you a check directly, that money could be scrutinized during a modification hearing as recurring gift income. Case studies from the 2008 recession show that courts sometimes impute gift income to men, assuming that if the parents helped once, they will help again. To avoid this, any financial assistance from family should be structured as a formal loan with a written promissory note, a defined interest rate, and a repayment schedule. By documenting the assistance as debt rather than a gift, you ensure it is seen as a liability on your financial affidavit rather than a hidden asset. Now, consider the 2026 reality of digital legacy and crypto inheritances. Many men in the younger generation are inheriting digital assets that are highly volatile. If you inherit $500,000 worth of a specific cryptocurrency, and that asset triples in value over the next 12 months, you are sitting on a massive capital gains liability. If you haven't updated your own estate plan to include digital asset protection, you are leaving your heirs with a mess. Your 2026 estate plan must include a specific digital executor and a clear roadmap for how these assets are managed. More importantly, you must ensure that these assets are siloed in a way that they never become commingled with any residual marital accounts or joint liabilities. Furthermore, we need to address the pension clawback risks in specific industries like aerospace, automotive, or government sectors. In a recession, some pension plans may become underfunded, leading to haircuts or reductions in benefits. If your divorce decree was written assuming you would receive a specific monthly amount, but the 2026 economic reality reduces that amount, you need to have proportionality clauses in your decree. This means if the total pie shrinks, her slice shrinks proportionally. Without this language, you could be legally obligated to pay her a fixed dollar amount that now represents 80% of your reduced pension, instead of the 50% originally intended. This is a mathematical trap that bankrupts thousands of retired men every year. There is also the Social Security offset for men who worked in the public sector. If you have a government pension and you are also eligible for Social Security, the windfall elimination provision, or the government pension offset, can significantly reduce your federal benefits. If your divorce attorney doesn't understand these specific U.S. federal rules, they might agree to a split of your assets that leaves you with far less than you expected in your senior years. You must provide your legal team with your Social Security statement and your pension benefit statement side by side to ensure the math accounts for these federal offsets. The goal of this part of the masterclass is to move your perspective from the next 6 months to the next 60 years. A recessionary divorce is a temporary storm, but your family's wealth is a multi-generational project. You are the steward of that project. By utilizing bloodline trusts, anti-modification clauses, and formal debt structures, you are building a fortress around your future. You are ensuring that the hard work of your ancestors and the future success of your career are not diluted by a legal process that was never designed to account for long-term wealth preservation. But there is one final piece to the puzzle. After the assets are split, the taxes are filed, and the legacy is protected, there is the matter of the exit interview. This isn't with your boss or your lawyer. It's with your own financial record. There is a specific one-year audit that every man must perform exactly 365 days after his divorce is finalized to catch the errors that the system inevitably makes. In the final part of this masterclass, we are going to walk through the divorce audit checklist for 2027. We will show you how to identify the 3 most common post-decree errors that lead to zombie litigation, and we will reveal the ultimate strategy for re-entering the investment market with the capital you fought so hard to protect. You are almost at the finish line, and the final moves are the ones that turn a survivor into a champion. The divorce audit checklist for 2027 is the final barrier between a man who has merely survived a legal process and a man who is ready to dominate the next economic cycle. We are now exactly 12 months past the final signature. In the world of high-stakes American finance, 1 year is the magic number where administrative errors manifest into legal crises. The courts have moved on, your lawyers have moved on, and your ex-spouse has likely moved on, but the financial systems of the United States, the IRS, the Social Security Administration, and the credit reporting agencies are just now beginning to process the fallout of your 2026 restructuring. If you do not perform this 365-day audit, you are leaving your flank open to zombie litigation, which is when a closed case is resurrected because of a clerical oversight or an unfulfilled transfer. The first item on your 2027 checklist is the title and lien verification. Imagine a man named Brandon in Nashville. Brandon's 2026 decree stated he kept the SUV and the boat, while his wife kept the primary residence. Brandon assumed the paperwork was handled by the attorneys. However, 1 year later, Brandon tries to sell that boat to raise capital for a new investment. He discovers that his ex-wife is still listed as a co-owner on the title, and more importantly, there is an old marital lien that was never released by the bank. In a recessionary market, Brandon loses the sale because he cannot provide a clean title. Step by step, you must visit your local DMV and the county recorder's office to verify that every asset you retained is titled solely in your name. You must also request a lien release satisfaction letter from every lender that was paid off during the divorce. Do not assume the bank did this automatically. In 2027, with the banking sector still tight, these administrative backlogs are common. You need the physical proof that the marital debt is dead. Next, we move to the IRS transcript review. This is the most critical component of Fresh Start accounting. In 2027, you should request a full tax transcript from the IRS for the years 2024, 2025, and 2026. You are looking for any notice of deficiency or math error flags that may have been triggered by your final joint returns. If your ex-spouse underreported income from a side hustle or claimed a deduction she wasn't entitled to during the final year of marriage, the IRS may be preparing an assessment. By reviewing your transcript 1 year out, you can identify these issues before they accrue massive interest and penalties. If you find an error, this is where you trigger the indemnification clause we discussed in Part 8. You have a legal window to force her to settle the debt with the IRS before it becomes a permanent blot on your financial record. Now, let's talk about the re-entry investment strategy. You have protected your capital through the depths of the 2026 recession. Now, as we enter 2027, historical trends suggest that market valuations may be reaching a point of attractive asymmetry. This is the moment to execute the dry powder protocol. While your peers were liquidating their portfolios to pay for legal fees, you used the strategies in this masterclass to preserve your liquid core. You now have a unique opportunity to rebase your investments at lower valuations. But you must do this with clinical precision. You are no longer investing as a family unit with a generalized risk tolerance. You are an individual with specific support obligations. Your 2027 portfolio must be structured to generate enough yield to cover your alimony or child support, ensuring that your lifestyle is funded by your assets, not just your labor. Case studies of men who emerged from the 2008 and 2020 downturns show that those who aggressively re-entered the market with a support yield focus were able to effectively neutralize the cost of their divorce within 4 to 6 years. We must also address the beneficiary cleanup audit. Even if you changed your beneficiaries in 2026, you must re-verify them in 2027. Why? Because corporate mergers and system migrations in the financial world often result in data reverts. If your life insurance company was bought by a larger conglomerate in early 2027, their system may have reverted to an older version of your file. You must log into every portal, your 401k, your HSA, your term life policies, and even your payable on death bank accounts, to ensure your ex-spouse's name has not reappeared through a technical glitch. This is the definition of a champion move. Being paranoid enough about the details to ensure your legacy is bulletproof. Furthermore, consider the 2027 credit score optimization. 1 year after your divorce, the utilization spike from your legal fees should be subsiding. You should now apply for a substantial credit line increase on your individual accounts. In a recession, credit is a tool of defense. Having a high available credit limit, even if you don't use it, lowers your credit utilization ratio and boosts your score, providing you with a safety net if the economy takes another dip. You should also verify that your ex-spouse has not opened any new accounts using your information, a phenomenon known as post-divorce identity theft, which often spikes during periods of economic hardship. Let's look at a scenario involving a guy named Marcus in Charlotte. Marcus performed his 1-year audit and discovered that his ex-wife had failed to remove him as a guarantor on a lease for her new apartment. When she missed a payment in late 2026, Marcus's credit score dropped 60 points. Because Marcus caught this in his 2027 audit, he was able to file a motion to compel immediately, forcing her to refinance the lease or provide a security deposit to release him from the obligation. If he had waited 2 more years, the damage might have been irreversible, potentially costing him thousands in higher interest rates on his own mortgage. This masterclass has been about one thing: the transition from victim to strategist. In the United States, the legal system treats divorce like a transaction, but the economy treats it like a liquidation. By applying a 10-part deep dive framework, you have navigated the 2026 recession with a level of sophistication that 99% of men lack. You have used the 10-year Social Security rule as leverage, you have tax-adjusted your support, you have defended your career against the promotion trap, and you have shielded your family's legacy through spendthrift structures. You are not just starting over, you are starting ahead. The final step of the champion is the mindset pivot. For the last year, your identity has been the man getting a divorce. In 2027, that identity must die. You are now the architect of the rebound. You have the data, you have the capital preservation, and you have the hard-earned wisdom of a man who looked at a financial execution and chose a strategic restructuring instead. The recession of 2026 was the fire that forged your new financial foundation. As the economy begins its slow, inevitable turn toward growth, you are the one positioned to catch the first wave of the recovery. While this masterclass concludes here, the journey of high net worth management never truly ends. The world of 2027 and beyond will bring new tax codes, new market shifts, and new opportunities. You have the baseline. Now you must maintain the discipline. You have won the war of nerves, you have won the war of math, and now it is time to go out and build the life that this entire process was designed to protect. The next chapter isn't about what you lost. It's about what you are going to create with everything you kept.